Yeah, clap it up for him. Jonathan does a great job doing this every year. Wow, this is a great audience. This is I'm used to being in this little auditorium, and this is fancier than we usually get here for the CEO panel. So this is good. This is actually my 5th year in a row of doing a panel. Every year there is some sort of topic. I think the first years were about liquidity providers, and then it went to regulation, technology. This year's panel is called Where's the Alpha? So what does that mean? It's basically a nice way of saying, how do we make money? And that's where we're going to focus on the panel and try to pick these guys' brains of the best ways everyone here can make money. But before we start, if everybody, I want to know in the room, who here is a broker, like a retail broker, prime broker, you know? Raise your hands if you're a broker. Okay, good. So that gives panelists idea that, you know, people will be using your advice, so, you know, don't be making these beer bets, you know, it's not going to work. We want hard soon. Okay, before we start, I want everybody to just introduce yourself, starting with you, Dave.
Yeah, David Finberg, Commercial Director of CMC Markets.
Mohammed Rasoul, Executive Director at TradeTech Group.
Andrew Edwards, CEO of Saxo UK.
Marc, Bürki, CEO of Swissquote Bank.
Brendan Callan, CEO of FXCM Group.
Okay, Mohammed, I want to start with you. This little, is it an echo okay? I feel like...
It's echo here.
Yeah, okay. All right. So Mohammed, I want to start with you. Your firm, Alpha FX, was acquired by TradeTech. It was about like a year ago it happened. And my understanding was the point was that they were specifically looking for your company, the knowledge in terms of risk management, i.e., you know, handling A-book and B-book. So as the market is getting a little bit more, you know, volumes are change limit during the ESMA rules, so B-book, being able to profit more from your flow is a more important part of the business. So without telling us exactly what the secret sauce is there, what are like some of the low-hanging fruit that people should be taking advantage of when they're trying to do the risk management and warehouse their trades?
It's a bit of a loaded question, right? So Alpha was acquired by TradeTech Group. You know, myself and my teams have been market making since the mid-90s. The recent ESMA changes, while new in this market, you know, leverage reductions are not new globally. So we've been through that quite a bit in the US market, in the Japanese market. Now we see it here in the EU. There's not really, I wouldn't, you know, there's no secret sauce. And I would say that, you know, we haven't fundamentally changed the way that we're making markets because of leverage reductions. I think that the thing that remains constant with retail speculators, any speculator that's trying to predict short-term price movement is really going to be ending up in the same position regardless of what type of gearing they're able to have access to. Because the mentality, the psychology of what they're doing and why they're doing it doesn't change, okay? It may change, you know, the life cycle of the customer, but the LTV doesn't necessarily change. So for us, what remains constant regardless of leverage is the monitoring of risk, making sure that we're prudent in what we do and how we do it. We do very much a lot of analytics on order flow, and that has always been the case. So my advice really to anyone in the brokerage space would be to continue doing what you're doing, but just be consistent. Look at the details, where you're getting order flow, the things that may change or shift the patterns of customer behavior are impacted by leverage. But predominantly for me, for my teams, for the group, it's nothing really new. So there's not something new that we've decided to do because of the leverage restrictions.
If I could add to that, I
Yes,
think
please.
something probably worth adding on to Mohammed's answer is that I'm sure there's a lot of firms in the room that have had to upgrade to a 730 license because of the no debit guarantee. And I think, again, just to add to his response, it adds the gap risk, so something FXCM knows a bit about. So I think firms should be doing a lot more stress scenarios and S&B type events to see what gap risk there is to the market moving through even new higher margin requirements that their clients are posting.
Andrew, do you want to add on that?
Yeah, I think it's more about customer retention. To your point, LTVs aren't going to change. I think to some extent, I think we could get more out of our clients for longer. So I think it's a focus on customer retention, a much bigger focus on the product range, on the execution quality, is where firms are more likely to now grow in this new environment.
Okay, so when you're saying that on retention, so is the goal you want to have them, you're expecting the same more or less LTV, but you want to have them for 6 months, instead of 6 months to 2 years? Or?
No, I think you could grow the LTV. I think if you start working with your customers in this lower leverage environment, keep them trading longer, then you can grow LTVs. And I was surprised to see at Saxo when I joined just how much longer the lifetime value is at that firm.
Okay, and what specifically do you attribute it to? Is that just more knowledge of just better risk management from clients?
I think leverage itself is what will deliver that. I think the problem people are facing is acquisition costs are high and they need to get that recovery of investment in marketing quicker, which is just not achievable in this environment. So what you do need to do is ensure that those customers you do acquire, you keep for longer.
Okay. And
one thing to add here. So every retail broker, every broker out there in the room and throughout the world, they have their demographic that they focus on, right? And if you look at, say, for example, your demographic versus someone else's demographic, it's going to be different, right? And your LTVs are going to be correlated to what type of customer. Is it the mom and pop that's open with 500 to 5,000? Is it a borderline professional that's 25 to 50? LTVs are highly correlated to that. And so now you really have to think about who you're targeting, why you're targeting them, what's your focus factor. In the past, you could afford to be all over the place. Just bring on customers and kind of take care of itself, and you could service everyone. I think now everyone in the industry is faced with this, okay, what do we want to be? And we need to be really good at that, right? And I think before the market, the industry was much more forgiving. That's probably the biggest change.
Yes, can I add something to that? I had a client who told me I want to trade the same tickets like before, when there was no leverage limit, and I told him you have to bring 3 times more collateral, right? So you can trade the same amount. I mean, it's about that. We have to explain to the clients that if he's bringing more collateral, he will do the same type of trading, probably with more security and less chance of being executed in a market spike. So there are positive news about the new regulations. It's not all negative.
Are you all seeing that? Specifically, I think CMC, David, you probably have the largest retail focus of the people there. Are you seeing customers put more collateral in order to make up for the margin differences?
Yeah, I think everyone was trying to gain answers upon ESMA coming in. So you've got to remember, when they came in, we also had 3 months of very low vol. So people were trying to unpick what's ESMA, what's market conditions. I think the key thing is just to look at almost AUM. So is there an outpour of cash? If there is, then that client base is seeking higher leverage elsewhere. As long as you've got that same balance of cash on deposit, they will use it as they see fit. And you've got to remember, the leverage is just restricting the size that you can get on. It's not restricting how many trades you can place. So for us, it's going back to that LTV. So for us, retention is paramount, and reactivations. We invest a lot in the clients, and we'll continue to do so.
David, I want to stay with you, because when they had the little app questions before, they asked the audience where do they believe the alpha is going to come from, and the top answer was technology. I know CMC has done a lot over the past 5-6 years, a big overhaul in both the front end and the back end of what you guys are doing clients. Where do you see technology playing in terms of the front end and being engaging clients, or is that where the importance is, or is it in the back end of really like handling things and making things more efficient on the operational side?
I think it's both, to be honest. You need to be able to cater for the new types of flow. So beyond the retail, you've got the institutional flow. But also it's leveraging off of the technology you have. So that's more white labels. As you know, we did the ANZ deal. So, that puts us number 2 in terms of stock breaking volume in Australia.
Can you say what deal was that again?
The ANZ deal in Australia. Yeah, ANZ Bank. So for us, it's leveraging off the technology we own. And then looking to more white labels, etc. So technology is paramount.
And Brendan, where are you seeing that in terms of technology?
Definitely the administration of what we do, the onboarding processes and the KYC automation and the selfies and autofills based on pictures of driver's license and passports. And we're integrating third-party technology and enhancing our proprietary stuff to improve there. For us, we're focusing quite specifically on algo traders and automation. So we have a suite of APIs and a slew of data feeds that we allow clients to download. We've got code libraries so people can start tinkering. It's a way forward for us. It's a bit of a hedge to the regulatory pressure in the retail space because a lot of the algo traders qualify as professional classifications and therefore don't have to comply with the new ESMA rules. On the services side, we're here this week pitching CFD Prime as a new revenue source for FXCM. So as far as I know, we're the first to do it and can do now through C2Cs with you and your liquidity provider, real-time give-ups of CFD positions, allowing firms to settle their CFD positions, take advantage of netting and cash management because they can post margin with one firm.
Staying with the topic of CFDs, one of the, over my years of being in the industry, I've noticed that there's always been a gap. It's been in the stock CFD liquidity. You know, you want to hedge any type of Forex product, no problem. You can have, 100 guys over here that could do liquidity for that. But if you want to hedge even, random, mid-cap stocks in the U.S., you're not necessarily going to be able to do that. So what I've been seeing is a lot of people telling us that when we do CFDs, we're going to warehouse everything and be-book it because there's a lack of good liquidity and whatever what's there is expensive. So in terms of the what's coming out and what's the new innovations in CFD technology, maybe Andrew, if you can just say a little bit more on that.
Well, in terms of coming back to your points about offering a broad range of single stocks is, a hugely complex part of organizations like ours, and that's why many firms don't go into it, because getting the access to the prime brokers or direct access to the exchanges is complex. I think more and more firms like Saxo and others here who have the infrastructure now are becoming a lot more open-minded to opening up that infrastructure to other brokers and giving them access to those broader products so that a lot of firms can focus on the acquisition, the retention of customers, the customer journey, the onboarding, and not necessarily get into the utility function of access to all of these exchanges. So I think we're going to see quite a big trend there where brokers just won't bother doing it themselves and they'll leverage off others to get that access, and everyone's a winner.
And one thing I want to highlight, because you mentioned that a lot of brokers are, when they try to expand their product lineup and they deal with liquidity challenges, their answer sometimes in the short term is just to inventory the risk. In single stocks, that's extremely risky. If you are a broker and you're trying to expand your product lineup and you think the solution to dealing with inefficient liquidity is just a warehouse of risk, whether that's crypto or single stocks, you are asking for major issues. It may not be today, it may not be 3 months from now, but it's going to be. So you have to be very careful. You have to evaluate your liquidity options and probably, kind of to your point, look to partner with someone who is an expert in that field. On the previous question you had on technology, one of the things that ESMA is doing for everyone in the space is having everyone look at how efficient they are, okay? And that, from a technological perspective, is all about the question of what should I build versus what should I buy? What really creates value for me? What can I produce technologically that will really create value versus something that I can just go get off the shelf? Because if it isn't creating value, you probably don't want to have it in-house. Because if you have it in-house, you're going to have people that manage it. You're going to have people that support it. You're going to have all kinds of additional costs, and that's going to take your bottom line from what could be maybe 30, 35, 40% to 5, 10, 15, 20%. And now that matters. And so I think that's that's an important thing, I should say, that everyone should be looking at inside of their own organizations.
Okay, but sorry to bring it back, but on the question of the stock CFD, so it seemed to be the bottom line is that if you don't have the infrastructure out there, then you should be looking to partner with someone else that does have it, either through a white label or some other opportunity, is there enough profit margins there to really make it worth the company's time to focus on it and to be rolling it out? Or is it?
That's a build versus buy thing, again, right? You don't have to build it in order to market and promote it and to be efficient and benefit from it, right? It could be a loss leader to you, but it could be the difference between, you know, you getting this customer versus that customer. You know, equities, exchange-traded products in general, those are very, you know, those markets have been around for a long time. To reinvent the infrastructure necessary to handle order routing for single stock equities, for exchange-traded futures and options, it's not cheap. And so if you're thinking about internalizing that from a technological perspective, I would advise you to think twice. It's very complicated.
On whether, if your question is on whether the product of offering single shares is worth it or not, we don't offer, so I can lend you our perspective on it. It's heavily broked. The commission rates have been competitively brought down quite significantly. So, and you can't rehypothecate the client money, so whatever you are offsetting has to be operational funds, and then there are more often buy and hold strategies being applied to single stock positions, so people will pay you a $5 margin in the beginning and then hold positions, and you have to do all the corporate actions there forward. So on a P&L basis and on a capital commitment basis, it's generally not worth a while. Where it makes a difference is your marketing spend. So if the FX rates aren't moving, if the indices aren't moving, but Twitter's about to do an earnings release or Tesla's got some big news and product release coming out, you can change your advertising spend to those specifically and get better click-through rates. So we will be looking to reintroduce shares sometime in 2019, and it's more to make our marketing spend efficient than to make a great deal of revenue off shares themselves.
Yes, but we all know that the single stock CFDs is more of a marketing gimmick, right? Because the volumes goes anyway into the index CFDs. So even though you would offer 4,000 different products, we ultimately know that the ones that are traded are, you know, DAX CFDs and those kind of products. So what our approach is to say, if you want to trade single stocks, then trade the single stocks. Don't go into CFDs, because then you have the real value and you have the dividends and you have everything else. So for index CFDs, this is a different story there. There I would go for the CFD. But it's funny how much marketing is there, and at the end of the day, out of a few hundred products, you trade 10, right?
David, I know you have it seems you have a very large selection of single stock CFDs. Do you have people that are looking at it and say, okay, I'm going to have a long-term brokerage account and actually use single stock instead of buying cash equities for their savings?
If you're chasing bottom line, then you'd probably list about 25 products and that'll be it. And that's where all your marketing effort would go. But you need the full package. So that's why, you know, we offer near 10,000 instruments. So people want to do your FX, indices, and your stocks as well. Going back to that lifetime value, then the higher value is in those clients that will trade across the asset classes. So for us, it's making sure that we basically supply what is being demanded by the client base. Again, most of the business is probably US. They all want to trade US. So if you're not offering it, they've got to have their account elsewhere. They've got to fund more because of higher margin elsewhere. And then if you're just offering FX, then you're only getting a small piece of the pie.
Do you have a portion of your clients are actually long-term investors and they're, you know, buy and hold type of people, or is it typically they're just coming in to trade it?
In terms of the holding period, it's longest on equities, but you know, you wouldn't be doing a CFD and paying the financing over a 10-year period.
It's very inefficient to do it that way.
I know IG had a few years ago launched like a stock brokering type of thing. I don't know how much traction they get, but the idea being to focus on long-term. But it seems to be that it's not the way to...
What we probably see more of is not so much buy and hold people on the single stock side. What we see demand from is people that currently have a portfolio of stocks that they're sitting on, and they would like to take that, transfer it to us, and use that as some form of non-cash collateral in order to be able to speculate on an intraday basis in other products, right? I mean, that's functionality that we have, that we offer both to our B2B customers as well as our high net worth, high value customers. Stocks are a hot topic because right now, given the changes in regulation, everyone is looking for something to talk about, and stocks are topical. There's always something cool happening, right? So the allure of wanting to have that is high, right? But it's also extremely difficult to offer. So it's a bit of a paradox.
And so talking about the hot stocks, so one of the ones lately has been cannabis stocks. I think I guess they're the crypto of Q3, Q4 of this year. Have any of you guys been launching those, like Telray, and I think there's a few?
Yeah.
Yes. You guys are. Is it been, Andrew, has it been something that you've been able to market to use as an acquisition tool for new customers?
Well, yes. I mean, we offer single physical cash shares as well, and where people haven't been able to get access through CFDs, a lot of the small Canadian stocks, we've obviously given it to them through cash products. I guess coming back to having this broader product offering, you're absolutely right. Single stock traders, and particularly those who buy shares, as you offer as well, they're a completely different demographic, but they certainly, when it comes to lifetime value, I mean, we actually see almost negative churn in that customer group because they buy, they hold, and they continue to add to those holdings, and then occasionally trade some of the other products. So I think in this new environment that we're operating in, having a rich, deep cash and CFD offering has huge benefits. With that comes obviously huge operational costs.
And Mohammed, one of the things, I don't know how much connected you are to it, but one of your sister companies at SafeCap, they launched a cannabis like index fund. So like, how does that work, or what's the logic behind that, or on the risk management? Is that like, how does it, details?
I think any of the topical things that are offered, whether it's cannabis or some new hot small cap or mid cap share company, I think we start from a very conservative point, which is we don't warehouse a lot of risk at all when it comes to single stocks. It's just which is why I cautioned everyone if they're doing that. Having seen what can happen when you do that over the last 30 years in the space, it'll get you when you're least expecting it. And I don't think some of the new things that we're offering is any different. I mean, we're very conservative about what we do. We don't run a lot of risk on it. To be honest, though, we don't accumulate a lot of risk on it. Again, a lot of these topical things, you're not getting tens of thousands of customers that are buying these things. It's a something to talk about to market that's different, right? And that's what everyone is looking for. So whether it's cannabis stocks or indexes or cryptos or whatever it is, we're doing a lot right now, for example, with baskets, right? And allowing customers to create their own custom combinations and their own indices, right? So you have to try to find a way to be creative. But from a risk perspective, I mean, we start from a very conservative position and then kind of work from there. So we're not a big, we don't run a big inventory of single stock exposure, regardless of what the underlying is.
Okay, I want to take it back to Jonathan for a second, see if there's any questions from the app that he wanted to add. Okay. So we have live questions coming here. So we got, how do you see institutional? How do you see institutional capital entering this crypto market? How will this affect the movement in the market? Anyone want to take a stab at this one?
By institutional capital, you mean market making, hedge funds, prop trading?
I assume it means all the big names like Goldman Sachs has been offering swaps and things.
Well, this market is in a very important part of any kind of young market becoming mature is when you start to see the institutions coming in. That's usually one of the first signs that the market's there to stay. But it's still very early days. I think what the institutions are doing now versus what they'll do 5 years from now will be very different. A lot of that will depend on regulation. But I think it's going to lend credibility to the market, to answer the question specifically.
Marc, you look like you wanted to add something there?
Yes, I think the end customer is still the retail clients. What we see actually is that our banks are entering the market with certificates. They would offer to their end clients. So and those banks, they need to have hedging partners, and they could do this with our institutions, for instance. But I haven't seen any large nostro positions going into crypto so far.
Ron, one thing on that, similar to what you were just talking about. Cryptos are in a tough spot right now. You've got the institutions coming in, but you don't have the underlying infrastructure to really help the institutions and the brokerage community facilitate the transactions in a way that they can depend on, right? The clearing element, the regulatory element, all of that, those types of things is, you know, it has to go up another few stages. For example, our group, it's very difficult for us to find an LP or a venue that we can face to deal with risk from a risk mitigation perspective that has anywhere close to the capital base that we would need in order to be comfortable, right? Until that changes, you know, it's going to be, you know, kind of wait and see for a lot of people.
Yeah, I think I think the investable ventures in the crypto space are on the infrastructure side much more so than on the trading side. The exchanges and the traders are going to face all of the regulations that we face. It's just a matter of time, and it's catching up to them quite quickly. But the settlement process still leaves much to be desired. And I used this example on a panel yesterday. The CME contract almost spits in the face of the zeitgeist or the ethos that brought about crypto in the crypto world. It's a very anti-establishment, distributed knowledge, distributed data, and nothing against the CME because this is their business model, but the crypto futures product closes 2 hours a day. It expires every month, which makes no sense. It's not an asset that should or needs to expire by any means, but it forces people to cross the spread again. And they're going to charge for the data, which very blatantly spits in the face of the zeitgeist that brought about the crypto world. So I think there's some exciting opportunity as far as investable ventures in off-exchange settlement, and there's some credibility that the CME brings to the table that I think should and will eventually exist off-exchange, and we're looking to do some settlement work on the crypto side as well.
I think we shouldn't forget where we are coming from. You know, like 1 year ago, you couldn't open a newspaper without a CEO saying that this is a scam or a fraud. You know, and also the G20, you know, wants to have an opinion about whether they will completely forbid this type of currencies or not. So there has been some very good news in this market. Now, volatility came down, obviously, and for us as traders, it had an impact. But on the crypto itself, the fact that now it has been recognized by most of the actors as being not being a scam and not being a fraud and being something that is part of the financial industry is very good news. Now we have to give it a little bit more time, you know, to find the right, as you said, you know, settlement agents and to let the cryptos go back into the normal financial circuits.
Brendan, I want to go back to what you mentioned, because last year at the panel, one of the big bullish things for the whole crypto market was the CME's launch of their futures. Specifically, the consensus among the panelists was that it would make hedging a lot easier to do, and a lot of the risks that existed by, you know, these fly-by-night crypto LPs that just disappear the next day, that would go away. So it seems to be you're saying that you still have those problems. But how is that any different than, you know, any other exchange-traded future like the DAX or crude, where they also have the monthly expirations?
It's not. You're talking to a biased audience, but we believe in the OTC business model, and exchanges are more or less government-sponsored monopolies. They don't; those worlds don't face the creative pressure, the free market pressures that we face. So, I mean, we've all been around for a while. Euro used to trade at 5-6 pip spreads. That's no longer the case. Because it's broke and because the pressures have brought pricing down, which is all good to the end client. So I believe these products, particularly the cryptos, should be traded off exchange, but there is the credibility element that still needs to come to the table. So whether it's a permissioned ledger or something along those lines, I don't think the product should settle on exchange. And like I said, just the fact that the CME plans to charge for the Bitcoin pricing data and eventually when they launch Ether the same, it's just against the grain of, again, the ethos that brought about the crypto world to begin with.
I would agree. I think your point is just that. We're coming from this perspective. This is how we've always done things, right? But what's exciting about cryptos is that it's something totally different, something totally new. And when you take that and dump it into the same old, you're really kind of undermining the value, right? Personally, I think there's something missing. I don't know what it is. When I think about it and figure it out, I'll let everyone know. But there's something that's not there yet, right? And it's going to take something that no one's thought about yet, at least that I've seen, that will be the catalyst that changes it. I don't think it's going to be everything being cleared on a centralized board of trade, because that's not new. That's not sexy. That's not what made crypto go from 1 to 20,000, right? The market will figure it out. That's the great thing about free markets.
Michael Lewis, the author of Liar's Poker, had a good analogy that I repeat quite a lot. He said if we were evolving the other way, meaning we were currently using and transacting using cryptocurrencies, and the largest governments of the world said, you know what, we'll stand up and back the value of this currency, everyone would say that's an obvious improvement. We will gladly go that way because now a central bank is guaranteeing the value of this currency. So I tend to look at the situation through those lens. Like Mohammed said, there's still opportunity here. It's new products. There's a lot of exciting technology that's coming out of it. But FXCM certainly is not pivoting away from fiat money or fiat currencies into the crypto space fully.
But who cares about the ethos of it? I mean, you're offering it as a CFD, and what does it matter if it's, you know, if you're going to be, I mean, obviously there's the market data charges, but how is it any different than, you know, crude oil where the CME is also charging for the market data there as well?
It's not, Ron, but what we're talking about is something that really has, for the first time in a couple decades, been innovative. Right? And so, yeah, it could just be another derivative that we trade on an underlying, but that's not going to be what keeps it around for the next, 100 years, right? And so I think that's kind of my point. I think that's kind of Brendan's point a bit, is that, again, there's something missing, and this market has a lot of potential. But yeah, it could stay as it is now, but it's going to be, just kind of this, yeah, we also offer this. But it's not going to be what can be, what it could be, which is something that fundamentally changes the way that we look at financial markets.
Andrew, I think Andrew wants to.
Yeah, I think one of the things that's also missing is, and even though we're all OTC and a lot of offer OTC products, we all rely on the underlying being safe custodied at some point with a level of regulation that supports what we do. So I think it's the safe custody and the regulator need to embrace the product. We need to find a way of ensuring that that the underlying hedge somewhere, wherever it's sitting, is safe, and that the regulator supports it. And I think until that time comes, and we know the big institutions are starting to dip their toe in the water because they don't want to be left behind, but they're not sure where to position themselves until those two issues get resolved.
Okay, so it seems to be the consensus, just to move on from cryptos, is that bottom line is it's available as a CFD. You can do it. There's ways to hedge it that are better than they were in the last 6 months, a year from now. But you're seeing that could be a complete change in as an OTC product that can just take things monumentally better in the future.
It's already migrating to the maker-taker model. So the same LPs that are pricing CFDs as indices CFDs and commodity CFDs are now pricing cryptos as well. And again, the competitive market forces bring prices in. So the short answer to your earlier question is, you can trade oil cheaper off exchange than you can on exchange, and that's currently the case with cryptos as well. And I don't see that element changing.
I think the issue is that currently the regulator has the saying, about crypto CFDs, and it's interesting the different approach between what is happening in Switzerland and what is happening in Europe. So in Switzerland, they say you can do whatever you want, you can give as much leverage as you want, but every single CFD position has to be balanced with an appropriate underlying equity. You as a bank, and they made it so unattractive that actually it kills the entire business. In Europe, I've heard that they will just forbid crypto CFDs. Well, they limit strongly the leverage, but it may well be that the next regulation will be you can't do this anymore. So, unfortunately, the regulator has a strong opinion about that, and we don't know yet what will happen.
I want to move on to another volatile product, the Turkish lira. Over the past year, it's been one of the more harder products to be trading, especially during off hours. One of the great things about the FX OTC market is it's 24 hours a day, 7 days, 5 days a week. Are products like the lira and then the ruble was 4 or 5 years ago exposing that maybe the market shouldn't be purely 24 hours and there should be, gaps for certain type of products?
The question is, it should be or shouldn't be?
Should it be? Should we look at it and say there's some products you only go 18 hours a day?
I don't know how that would help. I can only imagine the close, what's called the overnight gap, would introduce significant risk that's not currently there. A lot of the liquidity is algo-based liquidity now, and there's no reason those can't run 24 hours a day. So we operate in SpotFX, a 24/5 market. We're trying to push our LPs in the 24/7 space. There's no reason these markets should be closed.
And so you're not seeing that just the gaps in the market that do create these inefficiencies where they're just pricing all over the place. That
so if you're making the assumption that a gap would allow for the market to react and then recover to the pre-closing rate, I think that's wishful thinking. I think allowing 24-hour access to liquidity is the solution to sudden drops. Yeah, not the solution to, a mitigator of.
You're probably mentioning the various glitches that happens like 2, 3 o'clock in the morning, and that's a real issue, right? It's because it's even though the markets would be open 24 hours a day, the liquidity at 3 o'clock in the morning is very thin, and this is where all the catastrophe happens, you know. And when you're in a full broker model and you have to hedge all the positions instantly with the with market makers out there in the market, then you're exposed obviously to this incredible high volatility, and it is an issue. However, I don't think that just closing the market will solve the issue. It then would happen during the day.
And what you're seeing, David, in terms of liquidity, like from the algos, you see it's been improving, or has it more or less been stable? Sorry.
Yeah, you've got to remember that we have a duty to the client. So for us, the price that we derive, the liquidity we offer, it's all dependent upon the LPs. So, you know, you can take as many LPs as you want. You've got to derive a clean price to the client because it's not just the weekend gaps, it's the intraday gaps as well. But I think it goes just beyond the hours that it's offered. I think it goes more into how it's managed and what you're offering to the client. You know, so that comes everything from the margin that you're applying to the product, you know, the exposure caps that you're willing to offer at a single client level. So I think there's more that can be done rather than just extending hours.
I want to ask another post-ESMA question. One of the ways that there's two items as far as being able to handle the changes in the leverage. One of them is going from moving people onto the professional client, and I believe Andrew you kind of covered, instead of being a retail. How's that process been as far as moving clients from one to another? Has that been easy to do, efficient? Because I know you have to ask more questions.
Well, for the right clients who can evidence their activity or experience or wealth, it's very easy to do, and I think most of us have created a pretty slick upgrade path for those professional clients. I think what we have yet to see is the regulator step in and take a look at how firms are doing that. We know it's likely to be one of the next thematic reviews for them because there's been such a drive to do it. So it's been the right thing, and I think what is one of the positives from this has been that we've now more clearly defined what a professional client is, and provided you meet that criteria, then you should have access to high levels of gearing because that's the right target audience for that. If you don't meet that criteria, and I think we could argue whether that's a bit too onerous, but at the moment the line has been drawn somewhere, and if you don't meet that criteria, it's probably fair to say that the leverage levels that have been given are probably about right. So I think, but I think it will be a theme for the next couple of years on how firms have done that and have they been professional about it.
Absolutely, and I would really advise everyone to be very strict on that rules because this is, as you say, it's the next topic, and there you will face audits and controls, and there's no way of drawing the line a little bit softer. Or I would really advise everyone to be very strict on that because the fireback could be much stronger than what we are facing today.
We've not made a big push on it. There's a rule that's referred to as reverse solicitation, meaning if the client comes to you and asks, by the way, I would qualify as professional, can I opt up to that? We don't proactively encourage them to opt up. We've not made a big push, and some of our competitors put it on the home page, and we're very active in doing so. We have 100,000 clients, open to say, I think 15 or something like that opted up. It's a very small fraction. We weren't out there encouraging clients to avoid the ESMA rules and leverage requirements.
Okay. I want to end with one last question. it seems to be a lot, as you're all working with larger companies, that there's more comfort on the lower level of margin because the LTV is the same or better. A lot of smaller firms are struggling with it. Just they had a buildup of more regulation, and now less immediate. The LTVs are just being pushed out longer. So that's led to the annual cry of, okay, there's going to lead to consolidation in the market. Are any of you viewing that as a way to grow, or are you looking for opportunities now?
Well, so we did a couple of acquisitions in the past, and the problem is that the prices are still very high. The expectations or when you own a company and of what your company's worth is still very high. So there's probably some reality that has to kick in the market to see larger transactions happening.
Yeah, I'd second that. I think the firms that are in a position to buy are probably wise to wait it out and let the valuations and the egos fall from their currently lofty positions. And I imagine it to be there'll be more client book acquisitions than whole firm acquisitions. So again, those in buying positions have technology, have the regulatory licenses that they need. There's no IP that they need to acquire. It's generally just the revenue. And to some degree, the firms that won't stomach the lower revenue line in a post-ESMA world will just go away naturally, and their clients will also naturally be looking for new homes. So there's some element of, just wait it out, we'll pick up a good amount of the business naturally.
I think firms actually aren't quite sure because to your point earlier, because we have seen some a softer market since ESMA came in anyway. I think a lot of firms are still unsure of the actual ESMA impact and will need a bit longer before then they make a decision as to whether they need to recapitalize or whether they need to look to sell their client book or merge with someone else. So I suspect we'll probably start seeing more activity halfway through next year.
I think from our perspective, we're always looking for strategic opportunities to acquire either technology or businesses in emerging markets where we want to expand. I think that's a constant for us, just at the core of who we are. One point I want to make, though, is that the smaller firms, the mid-sized firms, I don't think that the way that the paradigm has shifted a bit on the regulatory side means that they all will go out of business. I think that if they look at what they do and how they acquire customers and are efficient in how they run their organizations, they can still survive and grow and succeed. It may mean that they don't do everything that they used to do before, but I don't think that this necessarily dictates that you have to have scale in order to survive. There's plenty of markets, there's room for everyone. There's demand for regional, customized offerings for specific countries, whether it's language or hand-holding or all different types of things. So it's just about finding your niche. Again, build versus buy type of thinking. Where am I spending money now that I don't need to? And finding a good partner to work with in order to accomplish that.
I would challenge that, just to let some sparks fly, I suppose. By way of example, the US market consolidated massively. The Japanese market consolidated massively. When these regulations come out, there is a flight to safety, if you want to call it that, where the client base ends up with the top 4 or 5 brokers in the region. And I do think it will take a while. And I don't think enforcement is homogenous across Europe, so it'll take a longer time for some firms to feel the wrath or the hammer come down if they're not abiding by the new rule book. But I do think in time the market will consolidate to fewer, bigger players.
I have to challenge that back.
I figured you would.
Yeah, but it seems to be...
Coming from the U.S. market, right? I think the U.S. is a bit of an anomaly. I think the thing that really destroyed the U.S. market was the bar to enter, right? That's not what we're talking about here. I mean,
the bar what?
The bar to enter. You went from a relatively low base capital requirement to this huge $20 million number. And I think technology also, since the 2000s when the leverage changes happened in the U.S., I just don't think it was as easy now to outsource key pieces of onboarding, marketing, back office, and really focus on what your value proposition is to the customer and acquire customers. I just don't think the tech was there then. I think it's there now. So I think it's just a little bit of a different space now versus then.
Yeah, and what I would add is regarding the consolidation, it comes down to what we're being offered. Are you being offered licenses in new markets, new products, what you're actually getting. I think you will see consolidation amongst the smaller players. You know, they've got MT4 platforms, there's synergies within that, but in essence, is it actually answering the capital question? They're all struggling because they haven't got enough capital. They want to run risk, but they can't. Then you've got the negative balance protection coming in. So I think a lot of these players, it makes sense for them to come together, but it's probably the same client base that's moving around. So for us, you know, if you came forward and you had a sticky client base, you're focused on retention, and you offered something that we didn't have, then yeah, we would listen.
Yeah, but I think there will be consolidation for sure. You know, we haven't seen the full impact yet of all the bad news that has come to this industry. You know, just think about, you know, there was MiFID II. Now we have these ESMA rules. There's Brexit coming soon. You know, so there's a lot of things going on in this market. So I fear still that there will be consolidation, and many companies will just go out of business. The consolidation will only happen when the prices are coming down, and as the pressure of the market and, you know, lower volumes, less profit will hit this industry. You will see a lot of smaller transactions taking place, and I agree that ultimately you will have a few big players in this market. Same thing happened in Switzerland. You know, we before 2009, you know, we had about 100 providers, and then FINMA came and said, "No, this industry needs to be regulated. You need a bank license, you need capital equity," and now we're down to 3, right? And there was still a lot of players here in Europe.
This can be another who buys who a beer next year situation.
Well, I would say to all the small, mid-sized brokers, if you're having challenges managing capital adequacy, managing your efficiency, managing your margins, and you still want to compete, TradeTech Group can help you with that.
Yeah, you're like you're sponsoring this thing, or they'd hook you up with a bill when you leave. All right, so just get to questions from the audience. So like we have them on the screen over here. So we'll go to the third one there. So is an industry-wide increasing of the spreads obvious solution to the monetization problems caused by ESMA? So who wants to fire first?
I'm not sure we can actually have that discussion.
Okay, so who wants to fire first and be the first one to actually raise their spreads?
That is not going to solve the problem. There's going to be spread compression, we know that. It's about optimizing our business models, coming back to the technology solutions. That's how these businesses will survive. Will be about reducing their cost base through reducing complexity and automating and optimizing.
Okay. Yeah, there's no reason to think spreads are going up because of this. Automation and efficiency is just a way of solving the margin problem that we face with a lower revenue line out of all this. So you see it. Firms are introducing a lot more automation, even in their chat bots. If you're looking for service, even in our industry, you're now speaking to robo responses more than individuals. And I think things like that technology is improving, so it's still a positive customer experience. And I think that will be the trend.
And let's go to the last question here. When will be a viable lending market in crypto or fiat on DLT to facilitate short selling of crypto to borrow or short? Basically, are we going to be able to short stocks on short crypto on a reliable process or not?
So in the maker-taker model I was referring to, where the same LPs that are pricing FX to us are now pricing cryptos, and in that sense, there's no limitations to shorting. So yeah, we're getting there, and FXCM allows limitless shorting now on Bitcoin.
I would agree. Same with us. Yeah.
You're seeing that at the moment is available, or
no,
just it's kind of
people are buying Bitcoin more than selling it, but the intraday traders have no problem going short for stretches of time. And like I said, we pose no limitations. So if someone does want to sit on a short position, they can carry it as long as they'd like.
All right. Any other questions from the audience? Not from the app? No? Okay. So thank you everybody for listening. Thanks to our panelists, and we want to wish you a successful 2019 next year, and hopefully we got some little advice and some value to take for the next year. Thank you.
Thank you. Ron has been modest. Thank you very much. Yes, that's the